Hello, this is Professor Richard Holizak from Baruch College, here with another mini lesson on stop orders. As always, the rest of my materials and tutorials can be found on the Financial IT category at holizak.com. So here's what we're going to do today. We'll do a brief review of limit order books, as well as limit orders and market orders and how they affect the limit order book. I strongly encourage you, if you have not done so already, to review my video on limit order books and review the video on limit orders and market orders. Stop orders won't make much sense to you unless you understand how the limit order book works and how limit and market orders work. We'll then go through the basic mechanics of stop loss orders. We'll talk about stop limit orders and trailing stop orders, and then we'll finish off the discussion. So first up, if you've reviewed the limit order book video, you know that each exchange maintains an order book for each security traded. This is sometimes called a limit order book or a central limit order book. And with limit orders, a trader will specify a limit price and a size, that is the volume or number of shares or number of contracts they're looking to buy or sell. They'll specify whether it's a buy or a sell order. Buy orders become bids, sell orders become asks. Sometimes those are called offers. And we like to say that these limit orders will add liquidity to the order book. They give others the option to trade with them. So limit orders are going to be adding liquidity, and they tend to be passive. They're going to wait for the other side to match their price. So for example, if you submit a limit buy order, you're waiting for a seller to come along and meet your limit buy price. Market orders, on the other hand, specify just a size, and they're going to trade immediately at whatever the best price is in the marketplace. They remove liquidity, that is, they take shares off of the book, and they are much more of an active strategy. They're going to take some volume, again, out of the limit order book at a particular market price. So here's a quick quiz just to test to see if you've gone through the limit and market order materials. Here we have an order book, and for each question, assume the order book is as above. I'll read off the questions quickly, then you can pause the video, jot down some answers, and then I'll go through what the answers are going to be. So first off, what is the current bid-ask spread? What effect would the following order have on the book? A market sell order to sell 400 shares. What effect would the following order have on the book? A limit buy order of 700 shares at $33.77. And finally, where would the following new order sit in the book if it was a limit buy order for 500 shares at $33.75? And again, assume the book stays the same here for each question. So go ahead and pause the video, and when we come back, we'll go through some answers. Okay, hopefully you have your answers jotted down. Here we go. What is the current bid-ask spread? Well, you may recall that the bid-ask spread is the difference in the best bid price and the best asking price. So here our bid price is $33.73, our ask price is $33.77, so the bid-ask spread is 4 cents right now, just the difference between those two prices. Next, what effect would the following order have on the book? A market sell order for 400 shares. Because this order is to sell, it will hit the bid side of the book, and for 400 shares, it would get a partial fill, 200 shares at $33.73. It would get another partial fill, 100 shares at $33.73, and then it would take its final 100 shares here at $33.72. So the top three orders would all get some attention here. Order 101 would be filled, order 104 would be filled, order 102 would be partially filled at 100 shares. What effect would the following order have on the book? A limit buy order, 700 shares at $33.77. This is what we would call a marketable limit order. It's a limit buy order, so it's a limit order. However, it's priced to already match the prevailing asking price in the market. And because it's for 700 shares, the following steps will be taken. First, this limit buy order will be filled for 200 shares at $33.77. The remaining 500 shares will go into the book as a limit buy order for for 33.77. The marketable limit order has the advantage here that it's going to take as much liquidity as it can at the limit price of 33.77, but it will go no further like a market order would do. Instead, it's going to rest back in the book, 500 shares at 33.77. And finally, again, if we start off with the order book as is, where would the following new order sit in the book? So a limit buy order, 500 shares at 33.73. Well, we see that that buy order already matches two orders, that are in the book. So because the 33.73 price matches here, it will be ordered third in the list. So this new order would come in, it'll become actually level 3 in the book. Again, because of the price time priority, a new order that matches on price will show up last in line here. So that new order would come in at level 3, order 102 would be pushed down, order 108 would be pushed down. Now we need to look at another quick review of how a broker processes an order. So we know that traders are going to submit their orders to brokers. So if you have a brokerage account with any online broker, you'll be submitting your orders to your broker. Your broker then makes what we call the order routing decision. So they have some leeway to determine where they're going to send off your order. We commonly think of brokers routing orders to exchanges. So right now in the US, there's currently a half a dozen exchanges that a broker might route to, and so that's a very common destination. So for a market or a limit order that the trader would submit to the broker would then forward that to an exchange. Brokers can also choose to internalize orders. That is, the trader may submit an order to a broker, and a broker may internalize. In other words, they will find a matching price inside the brokerage firm itself and match up those orders without having to go to an exchange. And then finally, the broker could route to an alternative trading system, or what is sometimes called a dark pool. And here, the same order book mechanism is going to go on. However, the bid and offer and the contents of the order book are not visible to the rest of the market. So this is yet another order routing decision that the broker can make. So again, just keep in mind, market and limit orders, the broker is going to send on to one of these 3 destinations. Let's talk a little bit about trading strategy. And so here we have a stock that looks like it's been down in price a little bit. The last price that we show here is $33.25. So the question is, if we believe that the price is going to go up, we may decide to buy 1,000 shares at $33.25. So let's say we enter the market at that price. And this is commonly called an entry point for our strategy. Well, what can happen next? Well, we might get very lucky, and the stock may take off in price. It may just head way up, and our entry point will be very, very profitable. We'll be executing a long strategy here, and we can profit from that. But what if the stock continues to slide down in price? Then we're going to take a loss on our position. Question is, how can we limit the losses? Here's where the stop loss order comes in. Stop loss orders are also called stop market orders or simply stop orders, or if you listen to some traders talk, they'll simply call them stops. They all pretty much mean the same thing. We'll talk about a few variations as we go later on in the presentation. They're typically used to mark an exit point in a strategy. We talked about an entry point, maybe where we're buying some shares to go long. The exit point would be the point at which we're going to sell those shares to close up our position. Stop loss order rests with the broker, and it's triggered by a particular price level. And so here's the first biggest difference that we see between what a stop order is doing and what a market order or a limit order would do. A stop loss order rests with the broker. It sits inside the broker's order entry system and waits for a particular price level to show in the marketplace. Once that price level is reached, then the stop loss order becomes a market order that will be, again, either routed to an exchange, internalized, or sent to an alternative trading system. Here's an example. Suppose we create a stop loss order with our broker to sell 1,000 shares at $32. What are we expecting to happen? This order will be triggered when the bid price in the market reaches $32. Because it's a sell order, we're going to sell to the bid side of the market. And so the trigger point will happen here when the bid price reaches $32. At that moment, our broker will then submit a market order to sell 1,000 shares. So there are really two stages to the stop order. The first is the trigger point, and the second is the submission of a market order. So let's go through some examples and we'll look at the mechanics of stop orders. Here's our order book set up here. 3202 is the bid, 3204 is the best ask price, and then we can see the rest of the orders that are sitting in the book, as we would expect them. So we create our stop loss order with our broker to sell 1,000 shares at $32. Currently, the bid price is $32.02, so our stop loss order will not be triggered. Another order comes to the market to sell 400 shares, and if you were successful in the quiz, you would know that a market sell order would go immediately to the bid side of the book, and order 121 will be filled for 400 shares. So that order will be taken out of the book. The rest of the orders move up in level. We still have our stop loss order sitting at our broker to sell 1,000 shares at $32. But once again, the bid price is now $32.01, and so our stop loss order is not triggered. Well, let's have another market sell order come in. Order 132 is going to sell 800 shares, again at the market. And so now we're going to have to look here at the bid side and see what it's going to take to satisfy this market sell order. First up, order 124 will be filled for 700 shares. So our new market sell order here will match up and they'll sell 700 shares at $32.01. So that order will go out of the book. That leaves 100 more shares, and those will be trading against order 122. They'll trade 100 shares at $31.99. So as a result, our order book now looks like this. We have 800 shares at $31.99 on the bid, another 500 shares at $31.98. Remember, our stop loss order is still sitting at our broker, looking for that price level of $32. So what happens now? Now our broker notices that the bid price is $31.99, so our stop order is triggered. It's going to go into action. And what happens when a stop order is triggered? In this case, a new order is created. We numbered it 133, and that will be a market sell order to sell 1,000 shares. So imagine now we've got this 1,000 share market order that's going to come to the market and sell to the bid side here. Order 122 will get filled for all 800 shares here at $31.99. But remember, our market sell order is for 1,000 shares, so we're going to continue on to the next level in the book. Order 128 will fill 200 shares at $31.98. And so the top level in the book is the remaining 300 shares at $31.98. Our market sell order has filled 800 shares at $31.99 and 200 shares at $31.98. So our weighted average price here will be 31.988. So our stop loss order has now completed. And the way that happened is the bid price, actually in this case, went below $32. That triggered the market sell of 1,000 shares, and we got two partial fills, 800 shares at $31.99, 200 shares at $31.98, and so our selling price is $31.988, our average selling price. Here's what's important. For a long position, we're going to protect our long position with a stop loss order to sell. For a short position, we're going to protect our position with a stop loss buy order to cover our short. Here's the important part. Stop orders may or may not trade at the stop price that you specify, and this is a common misconception. Traders, when they first get started, may be under the false impression that because they specify a particular price for their stop, that's the price at which it will trade, and that's simply not the case. Just as with any market order, if the market moves ahead of your order, that is, another trader cancels an order or another trader submits a market order just ahead of you, you're going to get an inferior price. In our example that we just showed, we didn't get any fill at all at $32, which was our stop loss price. Instead, we got filled at the next price down in the book because other market orders came in ahead of us. This is especially going to be a problem when markets are moving quickly. And probably the most common complaint that you'll hear from traders is they put a stop order in the book, but their stock was dropping in price so rapidly that by the time their stop price was triggered and the market order hit the market, price had come down even further. And so they get even more losses because the market moves faster than their market order can get to the book. Here's a typical broker order entry screen showing how to specify a stop order. So here's their particular code for an order type. This is STP. Limit price and some of these other fields are blanked out, and the stop price is prompted here. In our case, the order type is STP for a stop order, and our price is 32. It's a sell order. So this is basically, from a brokerage perspective, how we would enter that $32 stop loss order. The time in force here is GTC, which means good till canceled. We want this order to sit with our broker until we decide to cancel it. So here's another part of the trading strategy. Let's take the same setup that we had before. We believe that this stock is going to head up in price, and so we create our entry point to buy 1,000 shares at $33.25. So that's our entry point. We've now got a long position. We create a stop loss order to sell 1,000 shares at $33. So what we're saying here is if this stock drops below 33 or hits 33, we want to close out our position, because if there's bad news and the stock continues to go down, we want to minimize our losses at 25 cents a share or around 25 cents a share. So here's what happens. Our bid price moves down to $32.98, and that triggers our stop. As soon as the bid price moves below, we get a market sell order, and effectively our position is closed out. We've sold 1,000 shares at $32.98 or even worse, depending on when our market order hits the bid side. But then, as luck would have it, the market takes off. And here again, this is probably complaint number 2 in the list, is how come I got stopped out? How come my position got closed out and now this stock is on a tear? So really, the question here is where to set this stop price. And to be honest, I don't have any answers for you. It's very much an art as opposed to some sort of science or a formula that I can give you. Traders spend many, many years perfecting the art of where to place their stops. And we can see the dilemma here. If our stop order is placed too high, we will minimize our losses. However, we have this phenomenon where we get stopped out and the market can take off on us. If we set the stop price too low, then we're looking at taking a much larger loss, and maybe our portfolio can't tolerate that. And so, again, there's much more of an art to setting the stop price. That's probably the topic of many, many other videos of folks who do this day in and day out. But mechanically, you can see the dilemma of where to set this stop price and why that's going to be a big question for you. So here's another variation. A stop limit order works pretty much the same way as a stop order that we just talked about. The difference is, instead of becoming a market order when the price is triggered, it becomes a limit order when the price is triggered. And here again is our brokerage data entry screen for our order. We have a sell order for 1,000 shares, and this is called STP-LMT for stop limit order. And notice here there are two things that we're going to specify. Here's the stop price, that's going to be the trigger price on the bid side of the market. And then we have a limit price, and that's where our order will rest in the book. So again, because this is a stop order, this order will sit in the broker's database and it will observe the bid price in the market. When the bid price in the market hits $32 or lower, then a limit sell order at $32 will be submitted. Now, here's the dilemma with stop limit orders. It is possible, again with a fast-moving market, that our trigger price is met on the bid side, but then the market continues to go down. If our stop order turns into a limit order and sits on the ask side of the book at $32, if the market is moving down, we may continually be undercut. Other traders may come in with lower and lower asking prices, and it's possible that this order will never trade at all. Just like any other limit order, when it sits in the book, if a trader doesn't like our price, no one likes our price, then no one will trade with us. So this is the other risk side of this, that this turns into a limit order and that limit order will not trade at all. Okay, so here's our trading strategy part 3, and it's another variation on the stop orders. Suppose we have the same setup. We're going to get our entry point here. We're going to buy 1,000 shares at $33.25. And we're going to set our stop order to sell 1,000 shares if it reaches $32. So here's our stop out price here at $32. And maybe the stock comes down a little bit in price, but then it starts to take off. So we set our stop price just about right here, and we didn't get stopped out, and now the market is on a tear. Well, one thing that we might consider doing is, as the market moves up, we may want to cancel this stop order and put in a new one, maybe at a slightly higher price. After all, as long as the market continues to move up, we may even be able to set stops at prices where we're guaranteed to profit on our overall position. Remember, we got in at $33.25. So for example, we may want to look at the prevailing market price and trail that by about $1. And what might that look like? Well, if our market moves up to $34, we may want to cancel our stop and put it in at $33. If the market moves up to $35, we may want to cancel that stop order and put in a stop at $34, and so on. As the market moves up to $36, we may want to cancel that stop order and put in a new one at $35. Each time the market moves up, we want to ratchet up this stop order. Probably, though, we don't want to ever lower this stop order. In fact, to lower it would sort of be kind of counterintuitive here, because then we would be creating less opportunity for profit. So the whole idea behind this trailing dollar is, as the market moves up, we're just going to keep on putting stop orders as they move up. And so as it turns out, many brokers offer what they call trailing stop orders. That is, the stop price will ratchet up as the market moves upward. However, it's not going to move down. So here's again our brokerage with our sell order for 1,000 shares, and the order type here is called trail. The stop price, which is like an initial stop price, is $32, and our trailing amount we can put in as maybe $1. There's also an alternative here. Instead of putting in a whole dollar amount, we could put in a percentage amount, for example. So what will happen is, again, as the market moves up, a trailing stop will automatically cancel the prior stop order and enter a new stop order. And this will actually be done in a fairly continuous fashion. I've shown some discrete steps here, but what the brokerage firm can do is, as it moves up, it can continually cancel and replace, or cancel and enter new stop orders as the market moves up. And you can see the appeal on this. Once the market starts moving up, I can sit back and relax. I don't have to worry about closing out this position unless I, decide to hit my exit point. Maybe my exit point was at $37, and I would sell anyway. But this gives me protection as the market moves up. And if for some reason the market takes a sudden shift down, we've locked in some profits here by trading again. We'll stop out around $36. There's no guarantee that we'll actually get that exact price. So that's the idea behind trailing stop orders. So been going on a bit long here, but just as a summary, we did a quick review on limit order books. We talked about the definition and mechanics of stop orders. We talked about some strategies that you can use for stop orders. And we talked about some variations called the stop limit order and the trailing stop orders. As always, all of my material is available on holozak.com under the category of financial IT. Thank you.